You're listening to Money Talks. My name is Michael Campbell. Money Talks is brought to you by Solera Club. Solera Club is a royalty-type investment. That means you get paid first. It's in the tech sector, and there are no fees attached to it. For more information, go to soleraclub.com. You know, anytime I think about even mentioning anything to do with climate change, I start rolling my own eyes. I mean, rational discussion left the barn years ago. Free speech wasn't far behind. But be that as it may, I'm still hearing tons of talk about Alberta's carbon tax, push for one imposed by the federal government. A couple things to be clear on. The biggest problem with Canada's climate change policies, that gets to the heart of, by the way, why effective international action is so difficult, is that the costs of climate change policies are borne locally, but the benefits are dispersed globally. Politicians must acknowledge that fact in order to get support for climate-related policies. Their policies should reflect that. Policies to combat climate change are very different from so many other environmental actions. I'll give you an example. If a community decided to put a new tax in to raise money to clean up its water supply, unlike climate change, that cost would be local, but the benefits would be local. With climate change, the costs are local, but the benefits are global. Hence, policymakers should go to great lengths to mitigate the cost while pursuing effective action. I'm not saying this is an argument to take no action on climate change. It's demand for rational debate that includes a cost-benefit analysis of various policy options. And on that score, the research supports a revenue-neutral carbon tax over the regulatory approach. Economists also favor a carbon tax over policies like the massive waste of tax dollars that goes toward subsidizing electric cars or disasters like subsidized corn-based ethanol. Policy prescriptions must acknowledge that Canadian reality. I mean, come on, if you shut down all of Canada, we've got no people, no cars, no industry, no individual businesses, no machinery, no agriculture, the total reduction in global emissions would be under 2%. Well, that's what makes it tough to ask Canadians, or in this case Albertans in particular, to bear the cost of climate policies when the potential benefit in terms of reducing global emissions is minor, hence the need for a revenue-neutral approach. If reducing carbon emissions is the priority, then government shouldn't be looking to a carbon tax to raise money, regardless of what they promise to spend it on. If economic growth is the goal, then the research is very clear that it's far better to take the money and lower corporate taxes first and then individual taxes. I suspect the fact that the Alberta government's going to take in $6 billion a year into general revenues is a major reason why some polls show that nearly 65% of Albertans oppose the tax. Most economists would argue that when it comes to a carbon tax, there are two distinct questions. One, is a carbon tax effective policy in reducing emissions? And the answer is yes. And two, what should the government do with the revenue? That's a separate question. But this is the question that goes a long way to determining public support. By not giving the money collected back to individuals and businesses in the form of tax relief, as BC's done, the government changed the cost-benefit ratio for both the economy as a whole and especially for individuals. I mean, come on. Typical Alberta family with 2 children is going to see a cost of around $338 extra in 2017, $508 in 2018, thanks to the carbon tax. With rebates promised, I know, for low and middle income families, but there's also going to be about another $100 plus for an indirect costs. But for what? It will only make a minor reduction in global emissions, which then begs the question, why should Albertans foot the bill to lower emissions for China, Russia, U.S.? I'll give you another example. If all the oil sands production was permanently shut down, which of course prominent environmentalists advocate, Environment Canada estimates that would reduce global emissions by 0.12%. Well, in the meantime, shutting down the oil sands would result in the loss of around 22,000 direct jobs, estimates around tens of thousands more in related oil services, pipeline jobs, thousands in spin-off jobs in the service sector. It certainly cost the Alberta government a good chunk of the $2 to $2.5 billion in energy-related revenues they're hoping for this fiscal year, and tens of billions more if you take the accumulated revenue loss over the next 20 years. But why? All of that for a global emissions reduction of 0.12%, a statistical rounding error. I mean, Canadians say no to oil, no to pipelines. For what? Symbolism? Because it sure isn't meaningful reduction in global emissions. Instead, if the government had chosen a revenue-neutral model, the cost-benefit analysis changes completely. What individuals pay in carbon tax get refunded in the form of tax cuts. a complete change in the cost side of the equation. And I suspect a formula for garnering a heck of a lot more public support. If Rachel Notley wants more public support, it's time to get real. Recognize the public's tax fatigue and the economic costs of raising taxes in a down economy. Time to reverse course and go to a revenue-neutral model. Money Talks is brought to you by Solera Club. For more information, go to soleraclub.com. Hey, I really want you to stay with me for the quote of the week. This is an absolute beauty that certainly describes what we're doing on Money Talks better than anything else I've read. I got Rob Levy standing on deck, a couple of big stories for you to hear about. I've also got a big fat idea. Neil McIver's with me. And I've got Greg Weldon. If you know Greg, you're going to stay tuned, turn up the radio, get the kids, get the family together. All of that on the Money Talks Network. I've got a shocking stat from the world of sports, a really shocking stat from entertainment, and a very important shocking stat from the world of finance, all coming your way. Right now, Rob Levy joins me on the line. Hey, Rob, I'm sure you saw this one this week. How could we miss it? But, yet again, it's funny how so much Groundhog Day happens here because, of course, we can always get a Federal Reserve meeting talking about interest rates. But in this case, I'm talking about the OPEC meeting. Hey, yet another time to get the guys together to discuss production cuts.
Isn't that the truth, Mike? And I think Barclays, one of their analysts, just so beautifully summed it up in such a succinct sentence. OPEC saves space by kicking the can down the road to November.
Yeah, I mean, I've got to be with one of those guys, certainly from Missouri now, show me, because, I mean, how many times have they met over the last 8 years and not been able to come up with anything meaningful? And as you say, they haven't at this point. They're just talking about it coming November, and, of course, immediately when they start talking about production cuts, you get one of the countries complaining about it, or they want to get to their own peak production before they agree to freeze it.
Exactly right. And, I mean, it did have an impact that we saw this week because immediately on news of any sort of agreement, we saw oil prices climb 5% within a second, and it was earlier in the week. But, I mean, they're talking down the road. It was the first time they've actually come to an agreement in 8 years' time. But, I mean, even the numbers kind of give you reason to sit back and scratch your head because they're only talking about 700,000 barrels that they're going to cut out of a day production. So, in reference, that's about 0.75% of global supply and 2/3 of what's come offline in the U.S. in recent years. So what they talk about the shale region production and how quickly it can come back online. One's got to even question, is this going to have a significance on the market?
Well, I also think anytime if we ever got a sustained price movement upwards, into, let's say, into $60, what you'd see is a whole bunch of production coming back online out of the States, as you're just alluding to, Rob. So I don't think this is really significant for some sort of big trading range coming up a lot higher.
No, and that's where I absolutely agree with you. And I mean, even one more factor, you talk about demand destruction that happens going into the fall months of the year.
Yeah.
Greater than 700,000 barrels a day. So, I mean, there's a number of factors you can point to why this 700,000 barrel number is maybe a little bit of peanuts in a sense.
Yeah, I want to come to something we talked about last week. You were talking about the real change in the IPO markets, initial public offerings, and how the corporate finance was changing. And, interesting to see also on that side of the thing, I started to notice a whole bunch of mega mergers taking place.
They are. I mean, this year has been absolutely astounding. There's been $2.37 trillion in terms of value in mega mergers that have taken place this year. And it fits in the theme of how are we going to deliver value to shareholders in these kind of low economic growth environments. And, one has been share buybacks because you have to share profit. You use up some of that cash on the balance sheet and share profit among fewer shareholders. But another has been find a company in a similar industry and let's save some costs, and that's how we're going to grow our bottom line. So it's certainly been a theme of the markets. And interesting, of that $2.37 trillion, we're seeing 40% of it are international transactions.
And let me just finish with this. I'm not sure if you caught it. It was Ken Rogoff, is one of the heavyweights of writing of finance and debt and all of that kind of stuff. He's got a new book out. But again, we've been on a theme here for a couple of years that I think governments are going to move to a cashless society. It seems to me that this guy's really taken a vote in that direction.
He is, and this has sort of been a big hype this fall, is this book that he's put out, Mike. And it's interesting because, I mean, what's his thesis? It's that once you take interest rates below 50 basis points, that's where you have a problem with retail deposits on banking. But, I mean, this is sort of the general accepting liberal thought process here that we just got to remove cash from society, and that will allow central banks to continue to function and stimulate the economy, and it doesn't pay respects to the fact that maybe alternate forms of currency emerge. And we've seen it with Bitcoin, cryptocurrency. You see it in the gold market. It's a way to save your dollar. You're not going to get that gain maybe, but people do not want to lose their deposits. So it's an interesting premise and sort of discussion that's in its continuing stages.
Yeah, and let's keep in mind he's talking about negative interest rates of 0.5% there on one side of it, which is surprising. Hey, another little fact about him, by the way, he's a chess grandmaster, so maybe he's playing a little chess here out of Harvard University. But I'll tell you, if they get to a cashless society, that is just the ultimate for government to keep track of every little thing you do with your money.
Absolutely, and it puts them in control, which could be as good as you want if you like that, or as scary as you want if you're on the other side of it.
Yeah, I was trying to think of that book he wrote that got so much time. I think it's called This Time is Different, 8 Centuries of Financial Folly. I read that a few years ago. So it's going to be interesting. As you say, it's much anticipated, but boy, just another little check mark on that road to the cashless society.
Absolutely correct, Mike.
Thanks, Rob. Great stuff.
Thank you.
We're going to take a break. We'll come back. Hey, I've got my shocking stats, but right now I've got to get over to Neil McIver. This guy's got a great big fat idea for us. Maybe time to take some real estate money off the table. Ask him to get specific on that across the Money Talks Network. Well, it's always fun to have a live radio show because sometimes you get a little technical problem here, which we're dealing with right now. I'm trying to get Victor Adair on the line with me, trying to get Neil McIver, trying to get Greg Weldon on. Oh, it's going to be a fun show for you today. Lots of good things planned for you. The other thing I've got going, though, is I've got Ozzie Jurek looking at the most recent real estate numbers. Obviously, today is the first day of the month. We don't have the finished numbers, but he's got some numbers that are, as I say, they will adjust them as we come through the weekend, but he's got the ones that are hot off the press. He's been doing a lot of work on this. And I'll tell you, if you're looking for a strong Vancouver real estate market, I think you're going to get in for a bit of a surprise. I mean, maybe that blooms off the rose, so it's quite significant there. But it's been a significant week all around. I just talked about oil prices. Let me get Victor Adair on the line with me because there's so much to talk about. Vic, thanks for taking the time a little bit early today, but it sets the stage for Greg Weldon for us. As I keep saying, there's I start with that Clinton-Trump debate. That seemed to focus everybody, and the market certainly reacted to it.
Well, I guess the hype was there was going to be 100 million people watching, and my favorite barometer of how the debate went is how the Mexican peso has behaved, and that might seem a little odd, but it is tied. I'll tell you that the peso in the 2 weeks leading up to the debate fell steadily, the same time as Donald Trump seemed to be doing better and better in the polls, and immediately before the debate, the peso got to almost 20 pesos to $1 US for an exchange rate. In other words, that was an all-time low on the peso. As the debate progressed, Mike, the peso just started to jump higher as people were voting that, oh, hey, Trump's not doing so well. And we just kept going for the next couple of days. So we had quite a significant turnaround in the Mexican peso, right tied to the debate. And, in other markets, even Canadian dollar to some degree, the stock market to some degree, seemed to say Trump is less likely to do well, and Hillary's more likely to win the election. That seemed to be the market's take on the debate.
What about that kind of trading, though? I mean, that's certainly a trader. An investor shouldn't be looking at that stuff. But even as a trader, I guess if there's an opportunity, you take it. But it just seems like such nonsense. A little bit like the OPEC, too, when they sort of announce they're going to get together to agree to get together in November so they can not have a production. You know what I mean? And the markets move so dramatically now.
Yeah, well, I mean, the markets actually this week, my thought was the price action was very choppy. And it was tied to, a number of things, but certainly three things. One was the debate. The second, what I call the OPEC surprise announcement. And then, if we have a moment, we can get to it, what I call the European banking crisis. But I'll listen to what you and Rob discussed on the OPEC announcement. If I could add anything, I think that some of the analysts that I read saw that this Saudi Arabian willingness to be part of any supply agreement was a game changer, and their willingness was maybe brought about by deteriorating financial conditions in Saudi Arabia. Their stock market's been falling. There's been intense pressure on their currency peg. So maybe they decided that if they could do anything, to cap OPEC production, that would be good. Drew and I, our view on this is that what they were really trying to do was not so much cap supply, but they were trying to put a floor under prices. And, in the short term, they certainly got that. As Rob Levy was just saying, prices popped about 5% immediately following the agreement. So, you wave things around and, and maybe they got what they wanted is what I'm saying in the short term.
Let's come to that European banking crisis, because obviously I think that's the top story internationally right now, above what the OPEC thing is. And really, because it's, as we've been talking about on Money Talks, it focuses on Deutsche Bank.
Well, Deutsche Bank is a huge German bank. Their share price was $160 in 2007. It fell to $20 during the financial crisis, rallied back to about $80, and in the last few years has been in a steady downtrend, and on Thursday of this week was at $11. That's a long way down from $160. The American Department of Justice has threatened to hit them with a $14 billion fine for mis-selling mortgage-backed securities back, during the housing boom prior to the crisis in '08. And if they did hit them with that, that would wipe out their entire equity. Now, here's another take on the European banking crisis, and that is, for the longest time, I mean, everybody, the traders, they know it's there, but it's like tomorrow's problem. This week, it suddenly became today's problem. We saw on Thursday, I believe it was, just in the course of an hour, like the Dow Jones peel off about 100 points, particularly with weakness in bank share prices. So the risk of a contagion where one bank gets into trouble and then, sort of like measles going around, all the other banks get into trouble as well. That was the worry in the market. The German government says they will not come in and bail out Deutsche Bank, but of course everybody thinks they will. They have to. They can't let this bank go down. So it is a Gordian knot, that's for sure, but it's important to the market in terms of confidence.
I like that. You're right. It's a Gordian knot. We haven't used that on the show too often, but I like that analogy. Hey, Vic, we got 30 seconds for your short-term trading. What are you looking at?
We're staying with our view. We like the U.S. dollar against other currencies and commodities. We think that reaching for yield has caused many assets, including some stocks and junk bonds, to become overpriced while risk is underpriced. So we continue with our short positions in Canadian dollar. I was short the stock market. I took that position off. The market had a wonderful opportunity to go down this week. Didn't really take it, so I just stood aside. Yeah, so basically we're remaining bullish the U.S. dollar, short Canadian dollars, euros. We're short crude and gold. We lost some money on our short crude position this week, but made money on gold.
Great stuff as always, Vic. Thanks so much for taking the time.
You bet, Mike. Thanks. Bye.
Much more to watch. Victor Adair, of course, with us. Hey, stay with me. I've got a great quote of the week. It's one that you should hear. I've also got Greg Weldon. I love this guy. As I was saying earlier to Jill Bennett, he's the guy who makes me seem like an analyst. He's the adult, got the great voice, but even better analytics, the guy other analysts go to. So stay with us on the Money Talks.